All right, let's dive right in. Today, we're going to decode one of the most important skills in business, figuring out a company's financial health. We're going to show you how to take a boring page of numbers and turn it into a story that tells you, well, pretty much everything.
I mean, this is the question, isn't it? It's what keeps every business owner, manager, or even student up at night. You see money coming in, you see money going out, but at the end of the year, are you actually ahead? How can you really know for sure? Well, the answer isn't just a gut feeling. It's right there in a set of documents called the final accounts. Now, that name sounds kind of formal, maybe a little boring, right? But trust me, these aren't just reports. Think of them as the chapters of your business's financial story for the year.
So, think of this whole process as the annual health checkup for your business. It's a way to step back and see exactly what's working, what's not, and where you really stand financially. In this financial story, it's pretty much always told in three simple parts. Each one answers a different question. We start with something called the trading account, then we move to the profit and loss account, and we wrap it all up with the balance sheet. The cool part is, each chapter builds perfectly on the one before it. But before we start crunching any numbers, it's absolutely crucial to get one thing straight. These statements are different because they measure two completely different things. One measures the journey, and the other measures the destination.
Okay, so your income statements, and that's really just the trading and P&L accounts put together, they tell the story of your business's performance over a whole chunk of time, like a full year. You can think of it like a movie of your financial journey. The balance sheet, though, that's a single photograph. It's a snapshot of what you own and what you owe on the very last day of that year. It shows you exactly where you ended up.
So let's start writing our story. We're going to use a really simple case study, the corner bookstore. And we'll begin with the most basic question you can ask. Did the bookstore actually make money just from buying books and selling them? This first level of profit is called gross profit. It's awesome because it strips away all the other noise. Rent, salaries, all that stuff. And it focuses on just one thing, the difference between what you sold your stuff for and what it cost you to get that stuff. It really asks, is our main product even profitable? So here it is, the trading account. On the left side, you've got the costs. The bookstore started with $15,000 worth of books, they bought $150,000 more, and spent $10,000 on things like shipping. On the right, you see what that created. $200,000 in sales, plus they still have $30,000 of books left on the shelves. That gap between the two sides, that's our gross profit. And there it is, a gross profit of $55,000. Now, this is a huge first signal. It tells us that the bookstore's basic business model, just buying and selling books, is working. It's profitable. So with chapter 1 of our story written, we can start to dig a little deeper. But just selling books isn't the whole business, right? The bookstore has to pay its employees, keep the lights on, maybe run a few ads. That gross profit doesn't tell us if the business is profitable after all those other costs. For that, we need chapter 2. So we take that $55,000 gross profit from chapter 1 and carry it right over. Now we just start subtracting the actual costs of running the store, the indirect expenses. We've got $25,000 for salaries, $12,000 for rent and utilities, and another $5,000 for marketing. And after you pay for absolutely everything, the real bottom line, the net profit, is $13,000. This is the number that tells you the true story of the year. It's not just revenue. It's what the owner can actually say they've earned. It tells you if the business as a whole can actually survive and thrive. Okay, so we know how the bookstore did over the year. But what does it actually own, and what does it owe at the very end of it all? Let's move to that final piece, our financial photograph, the balance sheet. The balance sheet is built on three really simple blocks. You've got assets, which is all the stuff the business owns that has value. You've got liabilities, which is all the money the business owes to other people. And then there's capital. That's what's left over. It's the owner's piece of the pie. So check this out. On the right side, the assets, the cash, inventory, and equipment, they all add up to $150,000. And on the left, the store owes $37,000 to its suppliers. But here's where the magic happens. The owner's starting capital of $100,000 gets a boost from that $13,000 net profit we just found. And the result? Both sides perfectly, and I mean perfectly, balance at $150,000. Now, this isn't a coincidence. This is the fundamental accounting equation. It is the unbreakable law that makes sure the balance sheet always balances. Everything you own is either funded by money you owe to others or by the money invested in the business. It has to equal out.
So, we've seen the three statements and we've seen how they tell a story. But how do they really talk to each other? What's the secret principle that makes sure the story from the P&L flows so perfectly into that snapshot of the balance sheet? Well, it's all because of something called the matching principle. And it sounds fancy, but it's a really simple and powerful idea. All it says is that you should record an expense in the same period that you record the revenue that expense helped you get. It's all about timing.
Let's see this thing in action. Imagine the bookstore pays $1,200 for its insurance policy for next year, but they pay for it today. So according to the matching principle, does that hit this year's profit? No way, because that insurance expense is to help generate next year's revenue. So this year's profit is totally untouched. But look at the balance sheet. The cash asset goes down by $1,200, but a new asset called prepaid insurance goes up by the exact same amount. The balance sheet stays perfectly balanced, and it just holds on to that expense until it can be matched with the right revenue next year. It is literally the glue that holds the whole financial story together. So there you have it. You've got the tools. You can look at any set of final accounts and not just see a bunch of numbers, but actually read the story of that business, its journey, and its destination. The only real question left is, now that you know how to read the story, what will the next chapter be?